Good morning. Welcome to the Forex Pro Charts weekly analysis for the week beginning October the 10th, 2010. This week we are going to be reviewing the Euro Great Britain Pound pair, the Euro GBP, and we begin by looking at the monthly chart. Now, as you know, if you've been following us, every week for our subscribers we provide an analysis of 10 major currency pairs, and for non-subscribers we select one of those pairs and provide a video of our analysis of that pair. Again, this week the pair is the Euro GBP. As we look at the monthly chart, monthly time period, we are looking to see where in the trading field price is currently located. The trading field, as you know, is marked by the solid black lines indicating the previous monthly highs and lows, and in addition by the dotted large black lines which indicate the monthly and the weekly, again the monthly and the weekly armpits, or the monthly zone and the weekly zone. Now, the Euro GBP this month, the price is midway between the edges of the playing field, but as you can see, price is a little bit closer to this monthly armpit on the resistance side than it is on the support side. The support side has a pattern which is a little bit more typical of what we normally see, with the monthly armpit followed fairly closely by the weekly armpit and then the edge of the trading field. This is a very large monthly zone, and normally what we say is that once price passes this monthly armpit, we start to think that possibly price could reverse in this area. When it passes the weekly armpit, this area between the weekly armpit and the solid black line is an excellent area to see a potential long-term price reversal. So as price approaches this area, swing traders may be beginning to look for a zone where they can place a trade anticipating a long-term price reversal. For day traders, we can still trade either direction as long as the risk-to-reward ratio is acceptable. We can see that on the monthly chart, price has passed through the monthly extended trend wall, which was acting as a resistance, so we would expect to see price possibly continue up. Price is currently in a resistance zone, and we'll be examining the price action in that zone and the potential trades as we go down the time period charts. Let's take a look at the weekly chart. On the weekly chart, we can again see that price has moved through the extended monthly trend wall, which was acting as a resistance, and has moved up into the zone beyond the 60-minute armpit, and looks like it is basically hitting right at the 5-minute armpit. And we'll have to go to a smaller time period to see that more clearly. We don't want to base our decisions for trading on a weekly time frame chart in and of itself. However, what we do want to look at is the positioning of the zones and the chart pattern for the zones. So we are typically looking to see a rally base drop pattern on our zones. We will always see that on the daily chart. That's where we draw our zones. We don't draw the zone if we don't have that rally base drop chart pattern. But if that chart pattern is duplicated at the origination of the zone on the weekly chart, then that simply strengthens the zone, and for swing traders or other traders trying to anticipate where price will reverse long term, it makes that particular zone a more likely target when we see the rally base drop pattern on the weekly as well as the daily time period chart. So we can see here that price is currently in this zone right here. As we go back and look at the origination of the zone, that zone was a part of a larger downtrend. The support zone down here at about 8,200-ish had the drop base rally, and actually these are two stacked zones, one zone on top of each other with just a short distance in between, and actually it was the bottom zone where we had the drop base rally pattern. Same thing occurs up here above the monthly armpit. We see two stacked zones, and the rally base drop pattern occurred at the upper zone. So this zone and this zone below 8,800, and then the zone just below 80 or right at 8,700 are not particularly suitable for swing traders. They are suitable for day traders if the other criteria are present, but the zone around 9,000 is more suitable for swing trading. And then, of course, when we get to this zone just below the weekly armpit, there's a very clear rally-based drop pattern and a long-term price move down, and an excellent risk to reward ratio. So this zone in particular for swing traders would be an excellent zone to anticipate long-term price movement. Let's take a look at the daily pattern. On the daily chart, we can see where price returned to the support zone here. We had started our support zone over here. Price moved up, came back down, returned down, and just briefly touched that support zone, and then is moving back up and has gone all the way to this resistance zone. On its way, it has formed a couple of new support zones. Looking at the resistance zone, we can see that when price hit the daily armpit, right down here, indicated by the dotted red line at the bottom of the zone, we can see that price hit here. There was an extended monthly trend wall moving through, intersecting the daily armpit, as well as the daily trend wall, and the two intersected right there. We saw price bounce. Normally, we do not trade the bounce off the daily armpit because the risk is too large and the reward is generally not significant enough, and we find that the bounce off of the daily armpit is not as consistent as the bounce off the 60-minute armpit. However, some of our more aggressive day traders, when they see a pattern like this with intersecting trend walls right at the point of the daily armpit, some of our more aggressive day traders like to take that particular trade because these extended trend walls strengthen the daily armpit and make it more likely that we will see a bounce that makes it worthwhile. In that case, they would place their stop. If they don't want to place it up at the end of the zone, they might place their stop beyond the intersection or at the 60-minute armpit. However, this is a riskier trade and not one that we recommend in our signature trade setup. But we'll not be able to see this bounce on our hourly chart. We then can track as price moved up. Right here, it hit the 60-minute armpit, and again we see it had moved through the daily trend wall, and in fact is kind of spiking through the daily trend wall, making this not as effective as a resistance area. So we moved up to the 60-minute armpit, and price spiked through that 60-minute armpit a little bit, and then took a very nice bounce of almost 100 pips back down to about the daily armpit before it continued back up and hit the 5-minute armpit where it bounced again. Let's take a look at this price action a little bit more closely on the hourly chart. Now what we're looking for here is we're going to look to see if price continues back down. If it continues back down to this support zone, that the risk to reward ratio is very low on this 60-minute armpit. You can see that we also have the 5-minute armpit and even a 1-minute armpit. This would be very good for day traders to try to take the bounce off of these armpits. The risk is very, very low. Not a particularly good zone for swing traders because this drop base rally pattern is really pretty muted and part of an overall uptrend. As we move down to this support zone, if price were to move, not likely to move that far this week, but when it does reach there, we have a clearer drop base rally pattern, although another zone fairly close below that for swing traders would probably make a better option. But again, for day traders, this particular zone has a 60-minute and a 5-minute armpit, and would make an appropriate area to trade the bounce if price moves that low. If price moves up, we don't see it on this chart, but we do see that just above this monthly armpit there are two stacked zones. Again, for a longer term price move, we're wanting to focus on this zone. This zone here has a little bit more risk. Some day traders may wish to trade the 60-minute armpit in both zones, but when we see stacked zones, we generally like to pick the more favorable. In this case, it would be the upper zone. If you do trade the bounce off the 60-minute armpit in this zone right here, which would be the next resistance zone that price would reach, we would encourage you to really be very, very careful about protecting your profits, closing out a portion of your trade as soon as you hit the 20 pips, and then immediately moving your stops to break even. That way, if price immediately continues back up, as I would think would be fairly likely, you will have captured your 20 pips and you won't be losing anything, and you can try to capture a longer price movement up here. So back down to the daily, we can see that price has bounced off of the 5-minute armpit, which had virtually no risk other than the 10 pip cushion that we recommend that you place above the end of the zone. Has bounced back down nicely, and then we will wait to see next week whether price continues up past this monthly armpit or whether it moves back down. Looking at the hourly, we can see the price action a little bit more clearly. Price action on the 60-minute armpit is a little bit too far back for us to look at closely, but we see here at the 5-minute armpit where price hit that armpit, immediately bounced back down to the 60-minute armpit for a total gain of about 65 pips. Didn't quite get back down to the 60-minute armpit. Then moved back up again, bounced off the 5-minute armpit again. Where you have such a low risk, we normally don't suggest trading off of the 60-minute armpits. If it hits more than once, we recommend trading the first hit and not the second, because the second hit is very unreliable. Same thing with the 5-minute armpit, but in this case where you had made 70 pips, 60 or 70 pips off of the first bounce and price returned, your risk is minuscule, maybe 15 pips, and you've already made 65. If you wanted to trade that second bounce, that would have been possibly a reasonable approach, and you would have been successful, although you would have needed to be prepared to not be successful and see price move up. We recommend a smaller limit on the 5-minute armpit. If you're doing 50 off of the 60-minute armpit, you might want to be doing 10 or 15 off the 5-minute armpit, because the bounce is not always as significant, although again in this case this was a very nice textbook bounce 2 times off of the 5-minute armpit back down. So that completes our analysis of the Euro GBP pair for the week of October the 10th. For more information or to subscribe to our full analysis and charting services of 10 major currency pairs every week, please go to www.forexprocharts.com. We look forward to seeing you on our video analysis next week, and until then, good luck trading.